Yeah, normally it's funny because we also see it as kind of a training opportunity,
Yeah.
right? Or we also see it as an opportunity for you to develop. And when I joined Valsoft, I traveled a lot with Steph, our co-founder. We were working together, and we were probably doing 1 or 2 trips a month together. And you obviously build a great bond, a great relationship. I got to learn about the company. I got to learn about his philosophy. I got to learn so many things besides work, like life lessons and things like that. That it was a super valuable experience for me. So for us, we like doing that because it's a great opportunity not just to meet people, but also internally to help people become the best version of themselves. So we'll typically try to keep it pretty tight, like 2 or 3 people, because I think if you go a whole group of 8 people, one, like you said, you're swarming the sellers, it's a little bit awkward. But two, you're not going to get as much of that tight collaboration. Now, the way the team's structured, we try to everyone's kind of working on different opportunities. So everyone's kind of getting their turn. It's not like it's one over the other. It's just, on different opportunities.
Awesome. So I'm just trying to capture this. So you said 50 in the last 2 years. That's incredible.
Yeah.
And what does it look like in the future? Is that the pace you want to keep? You're going to expand it? You think it needs to be slowed down a little bit?
Yeah. No, that's a great question. I think it's obviously been great pace. I think we'd obviously love to continue on a similar pace. But for us, I'd say the difference between us and maybe some other parties, and I could be wrong on this, like the way we're structured is, we're going to do the best deals or the best acquisitions that we can do, right? If there's a lot of great opportunities in the market and we find a lot of great companies that fit our criteria and that these are people we want to do deals with and it makes a lot of sense, we're going to make those acquisitions. And if conditions change or gets to a point where we feel like we're not seeing the opportunities that are a good fit for us, we might do maybe a few less, right? The big thing for us is that we're primarily bootstrapped, so we're investing the profits of the businesses that we own. So we need to run things efficiently. We need to be the better operators we can be, the better acquirers we can be, the more we're able to do. And so I think that's really the kind of synergy that you kind of see in the model is that we're not, let's say, driven necessarily by outside factors as much as maybe some other parties, in the sense that, we're not looking at it saying we're buying. For the most part, we're doing these acquisitions, and I would say, when I say for the most part, I think almost all our acquisitions, we haven't really used any leverage in them, right? So these are cash acquisitions with cash on hand. So for us, it's not a matter of looking at it and saying interest rates are at an attractive level or an unattractive level, and so that's going to dictate what we can do. It's really going to be, if we could run our businesses better and more efficiently, well, then we have a lot more confidence in, what we're able to pay for businesses and what we're able to do in terms of acquisition volume and speed and pace. And that's really the way I think we think about it. So for us, thankfully, things have been really positive and working well. We're very happy with, call it the last 2 years. We kind of stress tested Valsoft in terms of having done a lot of acquisitions in a pretty short period of time. My colleagues on the integration team probably don't like us that much because we did stress test them. Let me put it this way: they all came in bunches, the acquisitions, but nothing broke. The businesses are running really well. We're really happy with the outcome. And so I think we've proven the model. I think we've proven that we can continue to move at a fast pace.
We're focusing right now, Ron, on the lower mid market. So
Mhm.
and I have everybody has their own definition of what is that, but I would say like our platform is great for advisors that are servicing the $5 million revenue to $100 million revenue market. So that's
Right.
really where there's a lot of there's a lot of businesses in that space. There's a lot of questions on the business in that space about like how much are their businesses worth, but what are their options and what to do to maximize their value. And they're also very great business for PEs to get acquired by. So that space is where we decided to focus first. And I cannot stress enough that if you're a founder, if you're a business owner out there and you're thinking about like, maybe selling your business or growing your business, that to your point, like to select a solid advisor that has a track record, experience into your space, that have been like helping businesses to your size and have done successful transactions is so important. Have access to tools and data to do their work properly, and not just like, well, trust me, I've seen this and your business is worth that. Or no, like I think that like it's a serious process. The problem that I've seen in this market, Ron, is that the business owners are waiting way too long to have those conversations. They're waiting to the very last minute to have those conversations. So there's a lot of things that you should do to get your business ready, but also to maximize your enterprise value and optimize the chances for your business to be sold. There's also a lot of businesses that never get bought because they're not like sellable. So what I'm trying to solve here is like, can I create a collaboration platform where the business owner can be more proactive, but also the advisors are also guilty. A lot of the advisors, a lot of your accounting firms or bankers are not having those conversations with their business owners, and they just wait at the very last minute when a business owner says, well, we're going to go to market, we want to sell this business, or we receive an offer from a PE or strategic buyer, and now I'm going to go and shop a broker or an iBanker, and I'm going to meet 5, 6, 7, 8, 9, 10 of them, and then it's a beauty contest. And my thinking is that the advisors that are proactive, they're having those conversations proactively with the business owners. Those are the ones that are winning. They're winning trust. They're creating value. They're having access to advisory and deal flow. So that whole idea of the concept of optionality is like, can we build a tool that would allow these two entities that are right now are disjointed, they're not proactive, they're not proactively collaborate to actually like change that and be more proactive in that process. That was like a big learning of mine when I sold my business before.
Deal killers. It's a great question. And this may not be the exact answer that you're looking for, but one thing I encourage everybody is to buy a good business from a good person, right? With the focus being on the second half of that. And that's, obviously you want to buy a good business. So no kidding, Eric. But buying a business from a good person takes care of a lot of the issues that you could potentially have in the deal process. And the issues you're going to have after the fact also. Now, how possible is it to determine whether somebody is a good person or a bad person over the course of a 90 to 120 day transaction? You may not know, but you also may know things like the treatment of the employees, the culture, the accounting practices. If you find things where they've, lied on their tax returns or they're paying employees under the table, and I'll be honest, like there's industries where like if you want to buy a landscaping business, like good luck finding one where they don't get paid under the table or they don't pay employees under the table sometimes. But if you're dealing with a good person, that's going to take care of a lot of the potential for problems that will kill your deal. Because what's going to kill your deal? Quality of earnings. That's where the vast majority of these deals are going to die. They're going to die after you lift the hood, you see the real financials, you get an opportunity to get familiar with the business. And, I get the emails every day. A lot of deals going under LOI, a lot of deals falling out in quality of earnings. The lending process. If you go hire a shitty lender, excuse my language, Ron, I don't know if this is there are
That's
children.
okay on the show.
If you go hire a tier 2 lender, they will kill your deal. They will make it a nightmare. They will leave documents sitting on the desk for 2 months that they haven't reviewed. They will ask you to change terms late in the deal. They will deny your loan deep in the process after you have spent a ton of time and money, and they'll leave you in a lurch, and that will kill your deal. Whereas if you had gone with one of the high quality lenders like Live Oak or First Bank of the Lake or Byline, you're not running into the same issue. And then too, having the right advisors to find issues early in the process. I know I'm being redundant because I mentioned quality of earnings, but that's such an important one. The quality of earnings is such an important thing that everybody should be doing in these deals right now, because not only will you potentially find issues that will kill the deal early on, but you also could solve some of the accounting confusion, the working capital confusion early in your deal, so you're not fighting about it later in the transaction. I've had transactions where if we would have done quality of earnings 3 months earlier, instead of doing it ourselves, we would have cleared up questions like, do checks clear when they go out, or do they clear when they settle, whatever. Now you're fighting about it at the 3-yard line. The seller is stressed, right? Everything's fine and well early on in the process. When you go under LOI, it's theoretical. When they start getting to the doorstep and they're thinking about life afterwards, and they see their tax bill, right? That's a big threshold that will kill a deal.
How do you show them, pick this company versus that company? You've got 3 deals on the table. What is your criteria?
Good question. At this point, we're a month into, they're already my partner. We're a month into learning what to look for. One of the first, let's say, tasks is to, once we finalize the roadmap, is to go out and find 5 companies you're interested in. And we get back together and we go over why these companies don't work at all, typically, because you just don't know what to look for in the beginning. That's probably the first, okay, I get it. I understand. That's probably the first aha moment that they have, because we really start targeting exactly like you said earlier, where I don't want to live and where I don't want to buy. This is what you learn. Typically, the majority of things in life is what not to do. There's only a few things that you learn that this is what I do. And so our first lesson is what we learn what not to do, what we're not looking for. And so I analyze each one of those deals and explain real quickly why it's not what we're looking for, why it doesn't fit our roadmap. It doesn't fit what you said. I see this in everybody, regardless of the intelligence level. I see it in everybody because it's just a novel experience. You've never done anything like this. And you can bring all your intelligence levels, you can bring all your past history, and everybody's the same. They don't know what they're looking for. So regardless of what I put out on the site, regardless of what books you read, you just don't know until you go through that first exercise. Then we go through the second one. And at that point, they're pinpoint. They know exactly what to look for. And they're out bringing companies into the pipeline. So inside the pipeline, I insert myself at different levels. Typically in the beginning, it's at the level of analyzation. So they go out, they get the NDA signed, they get the company info packet, and then we start analyzing them. And that's where I'm inserting myself in the beginning. We're talking to brokers. This is the second month. We're negotiating these deals. We're talking to brokers, and we're analyzing the deals based on what the criteria of the roadmap is, which is the important piece. We don't do anything that's outside that roadmap, that criteria for first acquisition, unless we change it. If we change it, we never do anything outside the roadmap. We can change the roadmap because it's a living document. If it changes, if the criteria changes, if new knowledge causes you to have an epiphany and say, okay, I want to do this. And we talk it through. And if we say, okay, let's do this, we change the roadmap and we look for companies that always fit the roadmap. I'm negotiating the deals. So I can read financials pretty quickly. And so I'm teaching people how to read financials. I'm teaching you how to come in and look for these LBO type deals, these heavily laden companies. And what constitutes a target company for us? What does constitute it? Just by reading on Biz Buy Sell. That's typically where we start, Biz Buy Sell. And we have a roadmap. We know exactly what to look for. And now we know exactly what not to look for. So we start weeding down. You start learning exactly what to look for inside these businesses for sale. Thousands and thousands, depending on where you are, depending on if you're local, if you're national. And that's how you learn. I remove myself from that analyzation once you learn how to analyze it, and I insert myself in a little bit further down in the pipeline. As you move through the pipeline, you're learning. Each individual is learning exactly what company is right for them based on their roadmap that we did for the first month. And again, if this new knowledge that you get changes that roadmap, we go change the roadmap. And so that's how you learn how to buy a business. At the end, we buy it. You've been through the whole process. You have the knowledge base to buy a business, and you just bought a business.
So when I started the Harbor Club, which is the kind of the mentoring, teaching side of things, I started it because I was being pestered all the time by people to come and work for them. So it was like, come and work for us and show us how you do what you do. You know, come and be a non-exec director, or come and be a consultant, help us buy a company. We want to buy a company, you know, this kind of stuff. So I kept saying no to all these people. But, you know, when you say no to so many people, you think there's got to be kind of a product or a service or something in that. You can't get rid of the entrepreneur in you. And then I bought a seminar business. And the seminar business was selling these seminars on marketing, on Facebook advertising, on all these kind of things. This was back in like 2008. So I thought, that's the solution. I can have a community for and a course for buying and selling businesses. But I thought I want it to be the anti-course, because most of the people that sell courses, you know, what is it? The old those who can do, those who can't teach adage, and most of them are really just marketing gurus, and they have this funnel. You know, so they sell you a little product, and then they sell you a bigger one, and then they sell you a bigger one. And it's kind of a relentless upsell. And I remember when I was a kid and I used to go to seminars, this would drive me crazy, because it would be like $59 and you're going to learn this and this and this over this 3-day course. And you're like, fuck, $59 for 3 days. That's amazing, And then you get there. The first day is just shit about how great the second day is going to be. The second day is, warming you up for the close. And the third day is just a pitch, like a whole day pitch for a 10, 20, 30 grand product that you have to buy to get all the stuff you thought you were going to get for the $59. Now, when you're an entrepreneur, 3 days out of your life is a lifetime. I mean, the shit that you could have got done if you weren't sitting there listening to this arrogant bastard pitch you all day, you could have really made some progress. So I swore to myself I would never do that kind of thing. And so we actually have an anti-course. There's no upsells. There's nothing you can buy from us apart from a membership. And it is a real community, lots of people in the community, and there's an app where everybody collaborates. We have face-to-face meetups and stuff. But what's been really good, I started it back in 2009. I had no idea it would be successful. I thought it'd just be a way of getting rid of these people that asked me to, work for them. And actually it started off with like 4 or 5 people in every group. Now, the one we're doing in London in April, I think it's 250 people. Now those are their existing members meeting up. This is not something we've sold them. This is a kind of group event. It's cool. It's got a real life of its own, and the product innovation that comes out of it, because everyone's sharing their ideas and coming up with new things. It constantly evolves and challenges my own ideas and everybody's ideas around different ways of doing deals. So it's been absolutely fantastic for my own development in this industry and getting stuff done. But I've been really lucky that the team I have around me in the Harbour Club pretty much take care of everything. In fact, I was asking, the live event with 250 people is in about 14 days or 15 days from now. And I haven't actually seen an agenda for it yet. I'm obviously going to be standing on a stage for 3 days. But I haven't seen the agenda of what's exactly what's going on. And all of that's been prepared in the background without my involvement, completely, from all the guest speakers from the Harbour Club community who are sharing their case studies and all of that sort of stuff. And literally everything is taken care of without me, which is kind of lucky, because I'm buried up to my eyeballs in deals at the moment. So we use this, Mondays, the project management software. So my whole team uses Mondays for tracking all the deals. But I use giant Post-it notes all over my wall. Well, it's a glass partition. And each one of those is a deal in various stages of progress. And so, we're really kind of buried in it. It's a very busy time. We're really buried at the moment. And so it's great that I can just turn up and speak when it comes to the Harbour Club. So, and I turn up and speak about the last thing we did, or the deal we're working on at the moment, or the one that we closed last week. And then it's super authentic. It's not like some big pre-planned presentation about a deal from 15 years ago. It's something very contemporary.
Yeah, I mean, there's a ton of great uses, I think, for sale-leaseback proceeds. I think the thing is, people just don't think of this as, in the mainstream or in the SMB world, like, they don't think of it as an obvious tool. They think of it still with like the view from like decades ago that like, oh, this is only for distressed businesses that need to like tap into liquidity. No, if it's, you need to buy equipment, use the sale-leaseback proceeds to go fund equipment. That's ROI generating. Get another production line in there. Use it to professionalize your management team so you can prepare the business for an exit. Use it to retire your other generation above you of parents that want to get out of the business, take some chips off the table. There's all these different reasons. It's really just an inflow of cash for whatever you need or want the cash to be used for. There's nothing in our agreements that says you have to put the cash into the business or use it to pay down debt or do something else. This is really, if you're the business owner and the real estate owner, it's cash that you can use the cash for whatever you want.
Yeah, there's a society-based mindset that renters or low-income renters are losers, right? It comes from the residential side of it. So everybody's like, well, I got to own my building, right? It's more business. It's smarter for me to own the business and I'm not paying rent. And I was like, no, rent's actually a deductible expense, right? Like you can write that off, as opposed to, I guess there's depreciation and other stuff on the real estate, but there's some real advantages of not owning.
Totally. And a lot of the time too, like the sale leaseback candidates, the real estate that we're doing these transactions around, they're pretty tertiary located. They're really not appreciating the way, if you took your sale leaseback real estate, did a sale leaseback, took the cash and bought sick home in Malibu, sure, yeah, like poo-poo the renters and hurrah the homeowners, but your asset's going to appreciate. But your manufacturing facility in the middle of nowhere, Iowa probably is not going to appreciate. So you're better off taking that rent expense tax deduction and hanging on to your property thinking it's going to sell for multiples more than you paid for it now in a couple of years, because it's probably not.
Before we ever go out and look at something real, let's spend a lot of time talking about what it is we're trying to buy, what good looks like, and then let's be really disciplined as we're out there screening potential companies to buy, because one bad purchase it can derail a management team for multiple years. It can take years to recover because of the amount of energy that has to be put into fixing a bad acquisition. I also tell you, don't buy fixer-uppers. It's like, let somebody else do the remodel. There's enough out there to where your focus should be ongoing concerns that have all the growth characteristics you're looking for. And good, is worth more than bad. And if it's bad, it's been bad for a while, you're going to spend a lot of time and effort trying to fix it. So I call it chasing shiny pennies. When you're trying to buy stuff, everything looks like a shiny penny, and you go off on tangents, just, trying to buy stuff for the sake of buying stuff. And, most companies, I use a cheap sports analogy, but if you think about the Ty Cobb had the highest batting average in the history of baseball. It was in the 400s, which means he struck out 6 times, or made 6 outs for every 10 at bats. In business, when you're doing acquisitions, you got to bat better than 900. In reality, probably got to bat about 950 to 980, in order to make it work. If you buy 20 companies, you could maybe afford one bad one in 20. But you really need to focus up front on what does good look like. And then you break it down into its different components. It's revenue of this size generated from this vertical, and it's this percent of profit margin or EBITDA margin. And, if the entrepreneurs are going to stay, the personality of the entrepreneur really matters. If they're staying with you post close, doing a buy and build. And so there's all these different criteria: union, non-union, customer concentration, verticals served, by the company. And, the more you can define what good looks like up front, and then what you do is when you're looking at all these opportunities, you apply these filters, and that's your funnel. And there may be 4,000 companies up here, and as they're shaking through your funnel, all you're focused on and putting energy and effort into are those that clear your hurdles, and those are good companies. And if you're disciplined by doing this, your chances of doing a bad acquisition are reduced just dramatically, and your potential for a better outcome is much more sound. And you could do this, don't even have to be doing a buy and build. You may be an entrepreneur seeking to buy a business to run, and you're looking at different kinds of businesses. It's really focus time and effort, know what good looks like, be disciplined, buy good companies. And if you do that, chances of being successful are dramatically improved.
Do search funds actually help do the growth through acquisition, where you help acquire the first one, they run it for a year or so, everything's solid, and you grow by acquiring other fragmented businesses in that space? Do you encourage that, and how does that play out?
Well, the way it actually works is it can never be the thesis, or it should not be the thesis when you take over. So when you come to your investors, say like, I really like this company, okay? They have to understand that this is a good company in the greater industry, okay? It shouldn't be a thesis of acquiring more acquisitions, because doing acquisition, and especially doing acquisition, is easy, but relatively easy. It's the integration that is so difficult. So if you look at the statistics of the experienced professional, there's only about 25% that create shareholder value by doing M&A, okay? And it's the reason why they don't, it's 3, it's strategy, it's finance, and it's PMI, it's integration. And the integration is the big one. And within the big one, it's typically culture. So can you imagine somebody who would run a company, that being the thesis from the start? So we kind of don't like that. If it's kind of next, and by the way, we could also do, that's another story. Now, you're totally right. Fast forward 3, 4, 5 years. If this person is in the fragmented industry and is now an experienced CEO who really has a good control and runs the company well, that has in certain amount of cases been the situation where he or she kind of acquires and integrates. I was mentioning the name of Peter Kelly. which are an incredibly successful searcher. Typical situation at the beginning, really not good, learning the business, strong search, putting the business right. Ultimately, they did 25 acquisitions and integrations. But I would say it's typically only after year 5 to 6. In a simplified model, what you could see 3 steps. Okay, the first 3 years are where you learn and you start doing some major decision making. Okay, and that runs until year 5 to 6, where you see the fruits of that decision making. And that's when most of them will actually move on or be sold, or when the investors kind of change. But the ones that stay in, typically year 7 plus, what you typically see is there the big financial decisions, higher level of leverage, or indeed, as you say, do M&A. But that's typically the third wave, where, and I don't have data on that, but out of the top of my head, I would say it's probably 15 to 25% who still does the last leg.
So saying that, like having that kind of down pat is really helpful, because A, it screens out all the people that aren't willing to invest in themselves, and B, it converts all those things that you're throwing off right now that are potential deal flow into deal flow. And so, and the other nice thing is that by putting up a filter of some fee for your initial working with them, you not only weed out the people that won't invest in themselves, but also you can pick up a decent side hustle income. So, for me, I started doing that, and it changed everything, because all the people that were taking up so much of my time and stopping me from hitting the goals that I had for myself went away. They instantly fell away. It now repulses the people who are exactly who I don't want to deal with, and it only attracts the people that I do. So that's the first thing, is that you probably have deal flow right now if you've got anybody asking for any kind of advice from you. And then the second threshold would be, okay, maybe you don't have anybody that's asking that right now. I'd say, well, you need to get out more. But if you don't have that, then you can say, okay, well, where can I find businesses? And so if you've got an existing business, I built a thing called an acquisition wheel. And I say, if you can ask the question, what do I want to solve for in my current existing business? And you answer that question, then that'll tell you what you should acquire. So I think having an idea of what is it that I want to acquire, what is my acquisition criteria, is really critical. If you don't have acquisition criteria, then you're going to maybe buy anything, and you could definitely buy the wrong thing. So those questions would be, what am I solving for in my current business? Do I want more customers? If I do, then I'm going to horizontally integrate. I'm going to acquire competitors, whether they're indirect or direct. Maybe I want more leads. Then I'm going to acquire media, people that have already aggregated the attention and eyeballs of my ideal customer profile. Maybe I need infrastructure or teams or other resources like that. Then I'm going to acqui-hire. I'm going to look for people that already have the teams that I want. I'm going to acquire them, merge them with my company. Now I've instantly got a sales team, a software dev team, an engineering team, an R&D team, etc. Maybe I say, well, gosh, I really would just want more sales, and I'd like to ideally have a higher average order value than I'm getting right now. Then you're going to look for other companies that have products or services that your existing customer base is already buying before, during, or after the time they're buying from you. Or maybe you say, I would actually like a higher lifetime customer value. Well, then you're going to look to acquire companies or products or services that have recurring components. Or you want more profit, then I'm going to go vertically integrate up and down the supply and distribution chain. Or I need innovation, then you're going to acquire IP, right? So those are 7 categories of acquisitions that really cover pretty much any challenge that you might be experiencing in your business that you've got right now.
Yeah. So the first book I wrote was in 2019. It became a cult classic almost instantaneously. It's called The Private Equity Playbook. And what I have learned even to this day, Ron, is that the vast majority of entrepreneurs and business people, even very sophisticated people, have very little working understanding of what private equity is and actually how it functions and works. And so I wrote that book to educate a generation. And just to drive home that point, just recently, a few weeks ago, gave a seminar, a few hundred people in the room, 350 people in the room. I gave this simple 10-question quiz, multiple choice. 90% of the room flunked. One person who passed got a 6 out of 10. And then I launch into not the answers to the quiz, but teaching about what private equity is and how it works. And the reason it's become so important is because today private equity has over 5 trillion in assets under management. It was 800 billion when I started long ago. Now it's over over 5 trillion. There were, 1,500 companies back then. There's over 6,000 firms now. They buy 50% of all companies that are sold on the planet are either sold to private equity or to a private equity backed strategic or private equity funded it. It's because of private equity we have a secondary market to sell a company into. And the multiples have gone up over time, and it's a lucrative way now to exit a business. And so I wanted to educate a generation what private equity was and how it worked. That was that book. Even private equity firms to this day buy that book by the case to hand out on college campuses to incoming associates or when they're recruiting to teach people how private equity truly works. Second book was the exit strategy playbook. And so while private equity does buy 50% of companies, there is still 50% of the market out there that's sold to someone else. When I bought 58 companies, other than 2 times where it was the person's second time selling a business, 56 times it was the person's first primary exit. And boy, there's this thing I wrote an article in Forbes called the arrogance of success. And I didn't mean that in a bad way, but boy, when you beat the odds and you build this 10 million, 20 million, $30 million company, whatever size it got to be, you all of a sudden think you're invincible and you know everything there is to know about anything. And I don't need help with an exit. And I saw that in the eyes so many times of people who, fortunately, I'm a good soul, good person, and I don't take advantage of people. But boy, there's a lot of novices sitting at the table with sharks. And those sharks, if they detect weakness, fair game is to make the deal lopsided to somebody else's advantage. And so I wanted to teach entrepreneurs about the importance of building a team of people, how to go through the exit process, what it looks like, how to even evaluate who you should be talking to. And I can't tell you how many times I tell an owner, just because your phone rang and it's a PE firm, with 6,000 firms out there, chances are really good that's not your buyer. You're wasting time, so know who your buyer is going to be.